David, we mentioned that Barclays note earlier today, and look, they say it's been a wake-up call, in their words. Retail traders are likely to continue to be a force to be reckoned with, and that will permanently affect the business models of institutional investors as that long-short risk protection strategy gets recalculated.
Yeah, it does. Listen, I mean, you can still short a basket of stocks. You're still going to try to put some hedge in your hedge fund if you are one of the managers behind the $3 trillion plus that is in that asset basket, so to speak. But, in talking to, and for years I've talked to so many of these largely guys. They're not going to short single names, that's for sure, Carl. They're just not. You don't want to do it at this point. You don't certainly want to ever be associated with a particular short position. That is where things sort of began to go bad for Mr. Plotkin at Melvin. Somehow people learning about his very short positions. And to be fair, it was a basket of retail names as well. And obviously he didn't have it properly sized. Perhaps he didn't fully understand how many other hedge funds were following him into those same trades, given the level of success that he's had over these last few years. I mean, his firm, he was up 51.4% last year. Year before that, 46%. So it does give you a sense as to his performance. But yeah, Carl, you're just not going to have single name shorts. And that's why a guy like Andrew Left, who's built a business over 20 years on it, saying, I can't do it anymore. Nobody's going to bother listening because the risk is simply too high at this point. Whether that will change, we'll see.
Well, and there's a conversation, I think.
And that has huge implications.
Go ahead.
No, I was just going to say, David, huge implications if you were unable to hedge the way you historically have hedged. To what degree do you de-risk on the long side? Those spreads get wider, markets get more brittle. I mean, there'll be a series of unintended consequences that we really don't even understand at this point.
Yeah. I mean, and there's going to be a bigger conversation to have around leverage, I suspect, as well. I mean, we can talk about that in terms of what we've seen in retail, the retail and investor landscape, and on a platform like Robinhood. But you can talk about that probably on the hedge fund side as well. When you wonder, just from a fee standpoint, what this does to that 220 model. I mean, that's been such a debate. How long, David, has that been a debate where the hedge funds are concerned?
Yeah, no, I always point out, I've kind of watched this industry become an industry. When I started, it was sort of five guys, and we didn't have Reg FD. There was an ability to sort of get close to that line. And then it became a true, as you say, true industry. And 2 and 20 has made a lot of people extraordinarily wealthy, and many of them, of course, not really putting up returns that were anything more than what the overall index did, or the S&P. And fees have come under pressure. Mm-hmm. There aren't that many managers out there, or certainly not as many as there once were, being able to actually hold the line on those numbers. That said, when you have a great track record, you can ask for what you want. The money seems to find you regardless. And that, of course, can sometimes pose a problem, because sometimes you get outside of your core competency, or sometimes you simply start to take perhaps more risk than you realize you are taking. And that may have been the case with Melvin. But yeah, we hear it a lot. Hedge funds are here to stay. The compensation structure, maybe not quite so much, although I did make the point yesterday, Morgan. I think it is worth making. They do serve a lot of different constituencies. They manage money for a lot of different types of people. It's not just about the enormous wealth that accrues perhaps to a handful of people at the top, although that is certainly something that I've been focused on for years and talked about and questioned. But that's the way the world works. They're not doing necessarily anything illegal, despite the fact that so many would like to believe they are.
Yeah.
They're not.
Yeah. I'd also just note silver. Silver's been jumping. You've seen that silver ETF as well. I think that started picking up last night. It's getting attention as well. This idea of a short squeeze playing out in that. It looks like J.P. Morgan as well named 45 stocks that could be susceptible to, quote, fragility events in the coming days as well, including some names that we've talked about on this show. Macerich, I know you've been pointing that one out, David.
Macerich, yep, absolutely.
Cheesecake Factory, Stitch Fix among the list there, too. So other names to just, I think, keep an eye on and watch, given some of the conversations that seem to be bubbling up around those.
Shepard Smith here. Thanks for watching CNBC on YouTube.